What if I told you there are dividend stock ETFs out there that don't just grow your wealth quietly in the background, but actually pay you a steady stream of income month after month, year after year? Imagine building a portfolio where your money is working around the clock, throwing off cash flow while still compounding for long-term growth. Sounds like the dream, right? Well, it's closer to reality than you might think. In this video, I'm going to break down 7 top dividend stocks that could supercharge your portfolio in 2025. Some of them focus on reliable blue-chip companies, others lean into high-yield income strategies, and a few strike a powerful balance between growth and stability. All right, before we continue, this video is not financial advice, and if you like this kind of content, hit like, share this video, and subscribe. The first dividend stock on our list is EPR Properties, ticker EPR, a real estate investment trust, or REIT, that specializes in what are called experiential properties. These aren't your typical office buildings or shopping centers. Instead, EPR invests in places where people go to create memories. Think movie theaters, ski resorts, golf complexes, water parks, and even entertainment districts. In other words, it's real estate built around fun and leisure. Now here's why that matters for dividend investors. REITs are required by law to pay out at least 90% of their taxable income as dividends. That legal structure makes them natural income machines, and EPR is no exception. Right now, it boasts a dividend yield that consistently catches the eye of investors looking for strong cash flow. But what makes EPR unique is that it doesn't just collect rent from office tenants or retail stores. It benefits from the growing trend of people spending money on experiences rather than just things. Even during uncertain times, consumers are showing a strong preference for entertainment, leisure, and lifestyle activities. That positions EPR in a niche of the real estate market that's very different from the traditional REIT model. Of course, there are trade-offs. EPR's performance is tied closely to consumer behavior. If the economy slows down and people cut back on entertainment or leisure spending, EPR's tenants may feel the pressure, and that can trickle down to the REIT itself. Add in the natural risks of real estate, such as interest rate sensitivity, and investors need to weigh the pros and cons carefully. Still, for those looking for a high-yield dividend stock with a unique twist, EPR Properties offers a compelling option. You're not just buying into real estate, you're buying into the experience economy, while collecting steady income along the way. Next up is Altria Group, ticker MO, one of the highest-yielding dividend stocks in the S&P 500. Altria is best known for its Marlboro cigarette brand, but the company has been diversifying into areas like smokeless tobacco, vaping products, and even cannabis-related investments. Here's why dividend investors pay attention. Altria consistently generates strong cash flow, and it returns much of that cash to shareholders. Right now, the dividend yield often sits well above 8%, making it a favorite for income-focused portfolios. Of course, there are risks. Cigarette volumes in the U.S. continue to decline, and regulatory pressure on tobacco and nicotine alternatives is always a factor. But despite these challenges, Altria has proven remarkably resilient, maintaining and even growing its dividend over the years. For investors willing to accept the industry risks, Missouri is a cash flow machine that continues to reward shareholders with one of the richest dividends on the market. Another standout dividend stock is Main Street Capital, ticker MAIN, a business development company, or BDC, that specializes in providing financing to small and mid-sized businesses across the U.S. Here's what makes Main unique. Instead of just paying quarterly dividends like most companies, Main Street pays monthly dividends. On top of that, it occasionally issues special dividends when earnings are strong, which makes it especially attractive for income-focused investors. The dividend yield is typically in the 6 to 8% range, and because Main invests in a diversified portfolio of private companies, it gives retail investors exposure to markets they normally wouldn't have access to. Now, there are risks. BDCs can be sensitive to interest rates and economic cycles. If small businesses struggle, Main could feel the pinch. But historically, the company has been well managed, with a long record of paying and steadily increasing its dividend. For investors who value steady monthly income and exposure beyond traditional public stocks, Main Street Capital has become one of the most reliable dividend players on the market. Next on the list is Exxon Mobil, ticker XOM, one of the largest and most established energy companies in the world. With operations that span oil, natural gas, refining, and chemicals, Exxon is what you'd call a true global powerhouse. For dividend investors, the appeal is simple. Exxon has built a reputation for paying reliable dividends through thick and thin. Today, it offers a yield in the 3 to 4% range, backed by billions in free cash flow. That consistency is why it's a core holding for many long-term income portfolios. What makes Exxon especially interesting is its ability to generate strong profits in both high and low oil price environments. The company has cut costs, streamlined operations, and invested in technology to stay competitive. Even when oil prices dipped, Exxon managed to protect and eventually raise its dividend, proving its resilience. Looking ahead, Exxon isn't ignoring the energy transition. It's putting money into natural gas projects, carbon capture, and even renewables to position itself for the future while still leaning on its profitable fossil fuel base. That balance makes it appealing to investors who want income now, but also want to see long-term adaptation. Of course, there are risks. Exxon is still tied to global commodity prices, and sharp drops in oil can put pressure on earnings. Environmental regulations and the shift toward clean energy are also long-term challenges. But with its size, efficiency, and history of rewarding shareholders, Exxon Mobil remains one of the most reliable dividend stocks in the energy sector and a favorite for investors who want both income and stability. Up next is Enbridge Inc., ticker ENB, one of the largest energy infrastructure companies in North America. Unlike Exxon, which explores and produces oil and gas, Enbridge focuses on pipelines, natural gas transmission, and energy storage. Think of it as the backbone that moves energy across the continent. For dividend investors, ENB is a standout because of its high yield, often in the 6–7% range. That's far higher than most traditional dividend stocks, and it's supported by long-term contracts that generate predictable cash flow. In fact, much of Enbridge's revenue isn't tied directly to oil and gas prices. It earns fees for transporting energy, which gives it stability even during commodity downturns. The company also has a strong track record of dividend growth, raising its payout for nearly 3 decades straight. That consistency has made it a favorite for income-focused portfolios, especially those looking for reliable cash flow. Enbridge isn't standing still either. While pipelines remain its bread and butter, the company has been expanding into renewable energy projects such as wind and solar, signaling its intent to play a role in the energy transition. Another favorite among dividend investors is Realty Income, ticker O, famously known as the monthly dividend company. Unlike most companies that pay quarterly, Realty Income delivers monthly dividends, making it especially attractive for those who want steady, predictable income. The company owns thousands of commercial properties across the U.S. and Europe, leased out to well-known tenants like Walgreens, Dollar General, and FedEx. These long-term leases provide stable cash flow, which supports its reliable dividend payments. Right now, Realty Income offers a yield typically in the 4 to 5% range, and it has a strong track record of dividend growth stretching back decades. While rising interest rates can pressure REITs, Realty Income's size, diversification, and consistency have made it a cornerstone holding for many income-focused portfolios. If you want steady, dependable monthly checks, O is hard to beat. Next up is JPMorgan Chase, ticker JPM, the largest bank in the United States and one of the most respected names in global finance. Under the leadership of Jamie Dimon, JPMorgan has built a reputation for strength, stability, and consistent shareholder returns. For dividend investors, JPM offers a solid yield in the 2 to 3% range, paired with regular dividend increases. What makes it attractive is that the payouts are backed by a highly profitable business model, with revenue streams from consumer banking, credit cards, wealth management, and investment banking. JPMorgan also tends to perform well in rising interest rate environments, since higher rates can boost its lending margins. That makes it a strong complement to more defensive dividend stocks in a portfolio. Of course, being a bank means it's exposed to economic cycles, recessions, credit defaults, and regulatory changes can all weigh on results. But thanks to its fortress balance sheet and history of navigating crises, JPMorgan remains one of the most reliable dividend payers in the financial sector.